Hi everyone, I'm James Shelligerdis, and I'm here with another True Wealth Advisors Group 101. This week, June 8th, we officially entered into a recession. So I'm going to show you some charts that I think will help add clarity and shed some light onto what exactly historically entering a recession has meant for at least for your investments. So first off, I think we need to clarify what exactly is a recession. According to our government statistics, what a recession is 2 negative quarters, so 6 months of negative GDP growth, which makes sense, right? We've essentially shut down sections of our economy over this time period. So we should have a recession. If we didn't have a recession, we're shutting down parts of the economy. That would be the real mystery here. Let's take a look at what historically this recession has meant for investments in the stock market. So going back to 1980, we have the gray bars and they outline all of the recessions. The red dots, though, are when the recession was announced. So when you look at this, what you can actually see is that by the time that they announce when the recession has started, we're usually very well into the recession, right? Because we're working on trailing data. Okay, so this is not leading data. This is after the fact, after the numbers in, and many times the numbers come in months after the fact. So what does that mean? Well, historically, what it means is if we're looking at the stock market a year out, if we're looking on the far right column for 1 year, what you would see is that the recession in 1980 and 1981 both had 18+% returns 1 year out from the date that they announced the recession. 1990 we had an 8%. In 2001, that was September 11, 9/11. So that was a little bit different. But even in 2007 and 8, where we had the financial crisis, 1 year out from when they announced that we were in the recession, 1 year, you had 35% returns from there. So let's just kind of break these down. Let's look at what happened here. If we go back to 1980, we can see the recession was announced, well into the recovery for the stock market anyway, because remember, the stock market tends to foreshadow what is going to happen, okay? Now, in 81, you can see they announced the recession and the stock market continued to go down. And yet, even so, 12 months out, there in January of 83, the stock market had made new highs. So here again, 1990 to 92. Now here's where we were talking as far as 9/11. You can see that the market did continue to go down. It's also important to note during this time period, we were in the midst of the tech bubble. So the market had actually been going down for a couple of years prior to this. And so with the way that valuations were back then, which they were astronomical, especially in the tech sector, that a lot of that just needed to be burnt off. So it wasn't necessarily just the recession that was driving this at that time. Here again in 2008, you can see the stock market was not done going down by the time. However, if you just held on and rode it out, you were in a significantly better spot from when they announced it. So here's where we are now. We already know, it's no surprise that the stock market back in February and March, pulled back to the tune of about 35% and has since recovered a bulk of that. And now they've announced it. So where we're going to be 12 months from now is still a mystery. However, if history repeats itself, we can guess that in 12 months or so, we're probably going to be in a better spot. So just a reminder, Our office is open for business as usual now. We're meeting with people again. We are here from you, and we'll hope to see you for your reviews this summer. We'll see you then.